Welcome to America's Gold Authority podcast. I'm your host, Mike Barnes. Joining me today, Philip Diehl, 35th Director of the United States Mint and President of U.S. Money Reserve. Great to see you, Philip.
Good to see you, Mike.
We also have Brad Chastain. He is the Director of Education for U.S. Money Reserve. Brad, glad you're here.
Happy to be here. Thank you, Mike.
Philip, I want to start with you. Where do the markets currently stand with the ongoing tariffs problem, the tariff war?
Well, there's a lot of uncertainty. Sort of settled down for a while, but there have been statements out of the White House and the administration that suggest maybe there's less room for comfort than they took right after those initial statements to sort of settle things down. And maybe there was a tendency of the market to grasp for straws when in the face of the panic they had after Liberation Day.
There are so many numbers we need to keep track of with interest rates and inflation and unemployment. How is gold affected by these numbers?
Well, it depends on the numbers, but the market and market analysts hang on the next set of numbers that are coming out to get a clue about how the Fed is likely to read the economy and then make its decisions about what to do. There are other forces that they read those numbers to predict as well, but the Fed is the most important variable that follows those numbers.
So many financial advisors are saying, with the economy right now, let's wait and see before we invest in anything. But the way gold has been going up and up and up, why wait?
You know, the way I look at that, you should never actually wait to have an appropriate portfolio. An appropriate portfolio should be in a position ahead of time to be able to deal with whatever lies ahead. And so waiting until you know more means that you're behind the eight ball. You're going to be late if you really do. And gold has been going up for a long time. It's not just there's been a little bit of because of recent uncertainty, spike in gold, over the last year or so, but it's a long-term trend. This is a trend that started in the early 2000s, even late 90s, you can argue. And financial advisors are really behind the eight ball in terms of how gold can play in a portfolio, because over that time, and we put the data to the test, gold has enhanced a portfolio in good and bad times. It's helped us weather the bad times more effectively, and it's been an incredibly strong performer during good times. And that is the huge misunderstanding that people have about gold, is they think that if things don't turn negative, then gold's the wrong choice. And history has shown us for quite a while that is simply not the case. Ever since we grew into this sort of debt-fueled world in the late 90s and early 2000s, gold has taken or reclaimed a place in the entire monetary system where it has been tracking the supply of debt, because debt has to be fueled by an increase in availability of money. As you increase debt, there has to be more money available in the system to refinance and roll over and repay debt. And gold is a monetary inflation hedge. So as that monetary supply increases, gold is right there along with it as that hedge. And that's not something that is going to stop anytime soon, regardless. That is a long-term trend. And it has put gold firmly in a solid place in a portfolio to be able to weather all of these storms. But you need to do it ahead of time. It's not wait till things get bad and then try to do something, because then it's too late.
I want to emphasize this crucial point that Brad is making here, and it has to be emphasized because it goes against all the expectations most people have about gold. And that is, gold is not just a bad news investment. It has performed extraordinarily well in good times too. And here is
I'm going to caveat, Philip, can I caveat that real quick? Because I would argue that the monetary expansion, debt-based monetary expansion that is driving it is a bad news story. It just does not reflect itself in the day-to-day economics and feeling of people every day, if that makes sense.
Yeah, it does make sense. But what I'm talking about...
It's happening. It's a bad news story that happens even during economic expansion, not just recession.
Well,
is that fair?
Yeah, absolutely fair. But that's not, people are not keeping their eye on where debt is going on a day-to-day basis or a week-to-week basis. That's working below the surface. What they think of as good news or bad news is my income going up faster than inflation? Do I have a job? Is GDP going up? Is the stock market going up? The value of my 401k? That's where most people are. And it's in that context where I'm saying there are good times and bad times. And what I'm saying is gold is performing extraordinarily well in both. And here's a good example. Last year was a great year for stocks. S&P 500 went up 23%. There's a good year. And gold went up 27%. So there was no sacrifice in holding gold as opposed to, the S&P index. This year has been a really tough year for stocks. And so far this year, stocks are down. I don't know exactly where it is right now, but between 6 and
It's about
8%.
11%.
Yeah, between 6 and 8%, stocks have been down. Gold has been up 27% already this year. So good year, bad year. Stocks have performed. Well, that's just a year and a half, less than a year and a half. What else? Well, over the last 5 years, gold has outperformed the S&P 500 over the last 5 years. And over the last 10 years, 5 out of 10 years, gold has outperformed the S&P 500. So this whole notion that gold is only a bad news investment when times are hard, uh, it's a form of insurance, but there are opportunity costs in holding gold. Uh, that's simply not true. It performs very well. So when it's part of a portfolio like what Brad has described, you get that wealth insurance aspect in hard times, but you also get real strong performance uh, in good times. And as Brad said, that goes back at least 20 years since the dot com blew up, probably before the dot coms blew up. And through hard times, post 9/11, the great financial crisis, the COVID-19 pandemic, we've seen hard times where gold has consistently outperformed other asset classes. But as the numbers show, they have gold has outperformed the S&P in many good years.
Yeah, and that's because a lot of those good years are fueled by monetary expansion that is driving gold. So there tends to be that what people think should be a negative correlation. They tend to move in the same direction because of the underlying driving forces of gold long term.
Well, and that leads to the question, what are the forces? The past is all well and good, but it's the past. If I didn't hold gold in the past, then, I missed that opportunity. So the question is the opportunity gone? Have we missed that opportunity? And the clear answer for me is no. And Brad has identified one reason why, and that is, does anybody believe that debt is going to decrease? The federal government debt is going to increase in the foreseeable future. Well, the budget that is sitting in front of Congress right now, if it's passed, will add between 5.5 and $11 trillion to the debt over the next 10 years. And there are additions like this 200,000 just in the last few days. The president suggested cutting income taxes or even eliminating income taxes on households making less than $200,000 a year. There are trillions of dollars in additional debt that would emanate from the enactment of that program. So I don't think any of us believe debt is going down. In fact, I think the expectation is the rate at which debt is accumulated is headed up.
And I would say, as far as in the near term, we're obviously sitting sort of on a knife's edge with the radical changes to the global economy that we're looking at going ahead. But even if things play out, if somebody is out there and believes that all of this is going to work out, the market's going to do well, the economy is going to do well, the reason why it will survive and do well is because there's going to be a much greater increase in overall debt levels globally to be able to fund these changes and keep the financial system going. And that alone is, again, a fundamental driver of gold long term. So regardless, it's just, in my mind, it's just a win-win having gold in a portfolio at this time.
It's not just U.S. debt. We're here in the U.S., we focus on U.S. debt. The reality is the debt in China, the debt burden in China is greater than it is in the U.S. And the Chinese economy is significantly weaker than the U.S. economy, and they are in need of substantial stimulation of their economy, especially in the context of a trade war. And so I expect to see significant increases in debt issuances by the Chinese. Also, I expect to see significant debt issuances from the Europeans because they are now in a situation where they have to basically create a defense industry to defend themselves against Russian aggression. So the amount of debt that's coming into the world market, and not even talking about corporate debt and emerging market debt, the amount of debt that's going to be coming into the market with the U.S. Treasuries competing in that market is going to be mind-boggling.
Philip, you used the word notion earlier. It sounds to me like it's just a mindset that needs to change, not only for financial advisors, but for consumers alike, knowing that gold is a good investment.
Yeah, that's exactly right, because the public has been told for 40 years, 45 years, since the 1980 inflationary spike, that gold is a bad news investment, that you need to have gold in case, the world comes to an end. And that has been the primary way gold retailers have messaged how the role gold should play in an individual's financial future. And it's simply not true. The data is overwhelming. And I know this because I've run the data myself. I've come to recognize over the last 15 years that narrative about gold just being a bad news investment isn't true.
And the wealthy have already figured this out. Family offices that are single offices that manage immense amounts of family wealth have been huge buyers of gold over the last few years. Hedge funds as well. Sophisticated investors don't just look at it as a bad time. They understand the role that it plays in a portfolio. Unfortunately, the normal financial advisor that works with individuals has not caught on to that fact. And I think they will, because if you think about what we're doing right now, it's a fundamental global economic rebalancing. Historically, what we have done is been a mass importer, sending dollars to the rest of the world. The rest of the world has recycled those dollars back into U.S. assets. And that has been a huge driver of U.S. stocks, keeping U.S. bonds up with yields relatively low historically. And if we're going to balance things out more, if everything works as intended by this administration, that means we're not sending as many dollars overseas. That means there's fewer buyers of U.S. assets to provide the same returns that we've seen historically. And again, the debt's going to go up. So that just it makes the case gold versus stocks and how much even more compelling, even though it was already extraordinarily compelling under the old paradigm. And advisors will figure that out eventually once they start running longer term data, but they haven't quite yet.
We've been talking about numbers that drive gold and that our clients and potential clients ought to be watching or aware of. And I've got a few of them to throw out here to you. We've been talking about how powerful the numbers have been about that have set the narrative and found as a foundation of the narrative that gold has performed extraordinarily well over the last 25 years in good times and bad. Well, over the short term, what does it look like that gold is going to do? And I like to turn to a couple of familiar names or how they forecast gold. Goldman Sachs and J.P. Morgan. And it's been fun to watch how these analysts, these big name analysts, have scrambled to keep up over the last 6 months to keep up with gold price increases, and how their forecast for year in 2025 gold prices has been surpassed time and time again over the last 4 months, and they've had to scramble to increase their forecasts. And so right now, the forecast for year-end gold prices that Goldman Sachs has set is $3,700 an ounce. And J.P. Morgan has set about 3,675. So they're in the same ballpark. Well, what that implies is an 11 to 12% increase in gold prices, pretty conservative, really, over the next 8 months. Well, their forecast for the S&P 500 is, in Goldman Sachs' case, 2.5% versus 11% for gold, and the forecast by J.P. Morgan is for the S&P to fall from this level by 6.5%. So the question is, why would you wait to buy an asset that is going to be outperformed either way, but may actually be losing value? That, here's one very credible source that is saying, oh, actually fall in value, why gold rises in value by 11%. But in either case, gold outperforms the S&P 500. So it makes no sense to wait, and especially when gold is just in this incredible rally.
Great numbers and great perspectives from both of you. Thank you so much, Philip Diehl and Brad Chastain, for all of your information today.
Thank you, Mike.
Well, that's all the time we have for today's episode. On behalf of all of us here at the U.S. Money Reserve Studios, thank you so much for tuning in. If you have any questions or want to learn more about today's episode, you can call the number in our episode description and speak with one of the friendly accountant representatives at U.S. Money Reserve. They're going to be happy to answer any questions you have about precious metals and the strategic role that they can play in achieving a secure and comfortable financial future. Again, I'm Mike Barnes. We'll see you next time on America's Gold Authority podcast.
The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.